This is Jody Trana with Chapter 10, Part 1 of Business Finance. Let's review our capital structuring scenario from the last class. We talked about a business that had $10 million in assets and also $10 million in equity. They wanted to expand their company and needed $5 million to do that. That would take us up to $15 million in assets. We need to cover that amount in some way. Last class we talked about covering that amount through borrowing, issuing 5,000 bonds at $1,000 each. Today we're going to talk about how they could expand their business by issuing additional stock. We learned about bonds in the last class, but how do stocks differ? Common stockholders are owners in a firm. They essentially elect the firm's board of directors, who in turn appoint the firm's top management team. Common stockholders have some rights. They have the right to the firm's income, but not until after bondholders and preferred stockholders have been paid. There's two ways that common stockholders benefit from holding stock. One is that they may receive dividends yearly, a form of income distribution that the company may do. Or if the company does not distribute dividends, the stockholders can benefit from that stock value increasing. The rights to residual income means that the potential return is unlimited. However, it also means that there may be little or nothing left after paying bondholders and preferred stockholders. And when a bankruptcy does occur, the claims of the common stockholders generally go unsatisfied. Before we talk about specific stock valuation methods, I want you to understand that there are 3 basic steps to valuing common stock. Step 1 is to estimate the expected amount and timing of future cash flows. Step 2 is to evaluate the riskiness of the common stock's future dividend payouts to determine the stock's required rate of return. And step 3 is to calculate the present value of the expected dividends by discounting them back to the present at the stock's required rate of return. So we're estimating the cash flows based on the risk of the stock and finding the present value. Because of the uncertainty and volatility of stocks, which is very much different than the bond market, there are many people assigned to the task of valuing stocks. And there are many different ways to evaluate stocks. We will concentrate on 2 methods, the dividend growth model and the price earnings model. Common stock's value is equal to the present value of all future cash flows that the stockholder expects to receive from owning the share of stock. However, unlike bonds, common stock does not offer its owners any promises. There's no regular interest payment, no maturity payment, and the dividends are not promised either. Before I introduce and we practice these 2 stock valuation methods, there's some terminology that we need to review. Retained earnings, retention ratio, PE ratio, and growth rate in dividends. Retained earnings is an accumulated number of all of the net income that has been retained in the business and not paid out as dividends. Here you can see a statement of retained earnings. To calculate the ending retained earnings, we start with beginning retained earnings and we add the net profit for the year. We subtract the dividends paid out, and the ending amount is the retained earnings. That's the amount of money that is saved and kept in the business to generate additional profits the next year. Here is the equation for ending retained earnings. Beginning retained earnings plus net income or minus net loss, minus the dividends. Let's just look at a quick example to calculate the current year's earnings. Bismarck had net profit last year of $1 million. Of that amount, $600,000 was distributed to stockholders. What is the current year's retained earnings? The answer is $400,000. This is the current retained earnings just for this year. If we wanted to know the accumulated balance, we would need to add this number to our beginning retained earnings balance. We're going to look at the same information as a relationship. It's called the retention ratio, and it compares the amount of retained earnings to the net income for the year. Let's look at Bismarck again. Bismarck's had net profit last year of $1 million. Of that amount, $600,000 was distributed as stockholders. What is the retention ratio? $400,000 is our retained earnings, and $400,000 is 40% of $1 million. So our retention ratio is 40%. This says that of every dollar of net income that we have, 40 cents of it is retained in the business. Now let's talk about the PE ratio, or the price earnings ratio. It's also called the earnings multiplier. The PE ratio is a relationship between the share price and the earnings per share. Let's say that Bismarck had a market price per share of $25. The company's earnings per share was $2.50. What is the PE ratio? With a price of $25 and earnings per share of $2.50, the PE ratio is 10. The significance of this number is that it provides a number that can be compared to other companies. The PE ratio represents a multiplier that is often used to calculate the value of stock. Let's talk about the growth rate in dividends. To calculate a growth rate, we can take the retention ratio, which is something we just talked about, and multiply it times return on equity. Return on equity is a relationship between the return, the net income of the business, and the total equity amount. Let's look at Bismarck's. It has a retention ratio of 40%. That's the percentage of income that is retained in the business. It also has a return on equity of 20%. Calculate the growth rate of these dividends. The rate of growth in dividends is a relationship between the amount of money that we retain in the business and the amount of money we make on all of our equity. In this case, it is 8%, 40% retention times 20% return on equity. Now let's talk about one way we can value stock using the price-earnings ratio. The price-earnings ratio is a ratio for valuing a company. It measures its current share price relative to its per-share earnings. The price-to-earnings ratio is also sometimes known as the price multiple or the earnings multiple. PE ratios are commonly used by investors and analysts to determine the relative value of a company's shares. It helps to compare apples to apples. It can also be used to compare a company against its own historical record, or to compare larger markets against one another over time. Because the PE ratio can be used as a multiplier, it also provides us with a way to calculate the potential stock price of a company that doesn't necessarily have a PE ratio. We can look at the companies within that industry to identify what a PE ratio could be and to use that PE ratio. Here's an example. Heels estimates their New Year's earnings to be $2 per share. What is HEAL's estimated share price using the PE method? What we're going to do here is we know what their earnings are per share. What we don't know is what HEAL's PE ratio is. Take a look at the competitors' PE ratios to determine which one to use. If we knew that HEAL's business model was very much like Steve Madden, we would want to use that PE ratio. Or if we knew that it was very much like Nike, we would want to use that PE ratio. But since we don't know, we're going to take an average of the 3 PE ratios that we are given. That average then will be multiplied times the $2 per share to identify a share price of $36.67. Now let's review the dividend growth rate model. Before we look at the equation, let's talk about the definition of these elements. First of all, we're solving for VCS, which is the value of common stock. D0 is the dividend that was paid in year 0. So that is the dividend that has already been paid. G is the expected annual rate of growth in the cash dividend payment. And D1 is the expected dividend for the end of the year. It's the same as saying dividend in year 0 times 1 plus the dividend growth rate. And then finally, we have R, common stock. That is the common stockholders' required rate of return for the shares of common stock. For your homework problems, most of these elements will be given to you. The main thing you will have to determine is whether the dividend that they are providing to you is last year's dividend or the dividend that's coming up. They'll usually make this pretty obvious, but you do need to remember what dividend in year 0 is compared to dividend in year 1. When we look at the actual equation over here to the right, you can see the elements that clearly make up the value of common stock. The upcoming dividend certainly has an impact on the value of the stock, as well as the dividend growth rate, which is part of our denominator. The one element that we really don't have much control over is the stockholders' required rate of return. This is often driven by the market, and when market rates go up, the required rates of return for our stockholders, they also go up and they start requiring a higher return. With these 3 elements, you can see how the value of our common stock can be determined. Let's look at a couple of examples. First of all, let's look at an example of a company that has no growth planned for their dividends. What is the value of a share of common stock that paid $6 dividend with no growth if the investor's required rate of return is 12% on that stock? Because there's no growth, we only need to concentrate on 2 of the variables, our dividend, which is $6, divided by our stockholders' required rate of return, which is 12%. With this valuation method, our stock is valued at $50. Now let's look at an example where there is some growth in the dividend. What is the value of a share of common stock that will pay $6.30 dividend, growing at a rate of 5% per year if the investor's required rate of return is 12% on that stock? Since we now have a growth rate, we will be using all 3 elements when we calculate this answer. Because we do have growth in this dividend, we need to make sure that we are plugging in our dividend number into the correct place in our equation. Is this dividend in year 0 or is this dividend in year 1? Your decision on that will change the outcome of this value of common stock. Because they're telling us that the common stock will pay the dividend, That tells us the $6.30 dividend reflects dividend in year 1. Dividend in year 0 is reserved for last year's dividend that has already been paid. In this case, we take our $6.30 dividend and divide it by our stockholders' required rate of return of 12% minus our dividend growth rate of 5% to come up with our value of common stock of $90. I wanted to revisit this slide that talked about the different stock valuation models. I just want to reinforce that we have only learned one model from the absolute valuation model category and one model from the relative valuation model category. There are so many types of valuation models because stocks, unlike bonds, are very volatile and can be very difficult to value. So there have been many attempts to come up with a valuation model that is tried and true every time. The valuation models that we've chosen to cover in this course, I believe, are a good example of the valuation models out there, but in and of themselves, they are not enough to use to value correctly a company's stock. You would need much more information in order to be solidly comfortable with your valuation of that stock. And sometimes, no matter how hard we try with valuation, there are things that happen, like COVID-19, that affect stock prices. Every time something happens in the marketplace, as you can see here with a new CEO, a new killer product, these things affect stock prices and may not be immediately identifiable in our valuation methods that we've been practicing. So it's always good to remember principle number 4, market prices reflect information.